If you've been relying on loans and credit lines from the bank to grow your real estate portfolio, you're cash flowing the hard way. There's an easier path to leverage your way to financial freedom that doesn't require a credit score, a loan approval process, or tapping into your property's equity. In fact, you get to control the terms on this line, the credit limit, the payment frequency, the payment amount, all of it. And this easier way is called whole life insurance. The only problem? Almost no one talks about it. But that's going to change today. My name is Slater, an Ivy League educated real estate finance consultant, and today I'm going to tell you why traditional lines of credit are limiting your growth, how whole life insurance is superior, and stay around to the end to learn the number one mistake investors make when using this strategy. And without further ado, let's break this down. What exactly is a line of credit, and why do traditional locks fall short for serious investors? At its core, a line of credit gives you access to capital up to a limit a lender decides based on your credit score and perceived risk. That means your borrowing power is entirely at the mercy of external forces, bank policies, credit fluctuations, economic volatility, you name it. So, leverage looks great on a spreadsheet until the market shifts or your lender gets skittish. Then it's their rules, their timing, and their risk management, not yours. Now, I asked ChatGPT for a good metaphor to include here, and it said that banks are like being in a relationship with someone who's all in when times are good, but backs off when you really need them. And in light of that, what I consider to be the best traditional lock to be in a relationship with, a cashback credit card, relies on short repayment timeframes, high interest, and rewards programs that don't matter when you're talking about large scale capital. Because let's be real, you're not funding a $2 million acquisition with Amex points. And when things go sideways, a furnace goes out, taxes spike, or a permit delays occupancy, you feel the real cost of traditional locks, not just in stress, but in compounded interest and lost momentum. And this isn't theory. I spoke recently with a 40-year multifamily veteran at CBRE. He said the same thing. Because most investors aren't diversified, they often get put into liquidity crunches, and lenders can smell desperation. If your capital's locked up or worse, borrowed, you're forced into hard choices. Either take on expensive debt or lose the deal. That's the real weakness of traditional locks. They look solid until they shatter at the touch of a finger. So, what if you could create a private, self controlled credit line, one that grows alongside your net worth, doesn't rely on lenders, and isn't subject to Fed policy? Let's talk about how whole life makes that possible. So, how is whole life insurance fundamentally different from a traditional line of credit? Let's break it down using the three core components of any lock: borrowing limit, credit qualification, liquidity access. With whole life, you control all three. Borrowing limit, it's based on your policy's cash value. Build more value, access more capital. No reapproval process, no external underwriting. Credit score, it doesn't matter. Life insurance companies don't check your FICO when issuing loans. Your access is secured by your equity, not your rating. Liquidity, it's built into the contract. If you have value in the policy, you can borrow against it. No freezes, no reductions, no third party interference. And it's not just access to capital, it's reliable access that's predictable, private, and permanent. That's what separates us from any traditional lock. Now, let's talk about interest. Loan rates vary by company. Some offer fixed 5% rates, others have capped variables around 8%, a few flow uncapped with market trends, but here's the part that gets overlooked. Your loan doesn't stop your cash value from growing. If your policy is earning 4.5% and the loan costs 5.5%, your net borrowing cost is just 1%, not 5.5. That spread matters, especially over time. However, it's not about hitting some perfect arbitrage every year. But compared to pulling money from a savings account or relying on a bank, it's often the more efficient move. Of course, this only works when managed wisely. Borrow too much too fast and you'll cancel out all the benefits. But when used with discipline, the strategy gives you flexibility that traditional locks can't match. Even at higher Fed rates, policy loans tend to be less costly than credit cards, business locks, or unsecured bank financing, especially when you factor in the ongoing growth of the underlying asset. Now that we've covered interest, let's talk about how borrowing from a whole life policy actually works. Think of it like mortgages and real estate. You make payments, insurance premiums, and in return, you build equity, the cash value. That cash value doesn't rely on property appreciation. Instead, it grows through guaranteed interest and dividends from the insurer. Eventually, just like tapping into a HELOC on your home, you can borrow against your equity, except here it's called a policy loan. But here's where things really split. A HELOC requires approvals, appraisals, and lender discretion. If the market shifts or your credit profile changes, you might be denied access to your own equity. Policy loans work differently. As your cash value grows, your borrowing power automatically increases. No approvals, no underwriting, no waiting. That means you're not just building equity, you're building liquid, accessible equity, and you don't need a third party's permission to use it. Okay, one small caveat. You do still have to call the insurance company or fill out a quick online form if that's more your speed. But it's a small trade off for something rare in today's lending landscape: control. Because unlike a traditional loan, policy loans are unstructured, meaning you can repay them on your own terms. Interest only? No problem. 5-year repayment plan? Go for it. Hit pause during a rough quarter or school tuition spike? That's allowed too. Just don't go overboard. If unpaid interest compounds to the point where it depletes your cash value, your policy can lapse. And yes, that would mean losing the policy and the benefits that come with it. But even then, it's not foreclosure. No debt collectors, no asset seizures, just the loss of your private line of credit and death benefit protection. That's about it for the basics. So let's say this all sounds good to you. You're sold on the strategy, you want the control, the liquidity, the growth. You sit down with a local agent, someone who sells plenty of life insurance but knows little about real estate. They plug you into a cookie cutter policy, and you trust that it's handled. 2 years go by. You've been paying premiums, you've got a new deal lined up, a great location, strong rent roll, and room for appreciation. You call the insurance company and ask the all important question: how much cash value do I have available to borrow? Their answer: zero. How? This is where most investors go wrong. They don't structure their policy for early liquidity. A traditional whole life policy is like a 30-year mortgage. Your first few years of premiums go mostly to internal costs, not cash value, just like how early mortgage payments mostly cover interest. It's a long horizon, and that's great for building a legacy. But if you want cash value soon for deal making, you can't afford to play by default rules, and that's why policy design is everything. You may need to front load premium, make extra annual payments, or set a shortened funding window, say 10 or 20 years instead of 50 plus. It depends on your portfolio, goals, and the insurance carrier. And if you want to know more about all the different factors that go into designing a policy for real estate specifically, you can check the description to join my newsletter. Just reply to the welcome email with the title of this video, and I'll send you a PDF breakdown. But whatever you do, here's the truth: design it right from day one, and you'll always, always, always have a private, flexible source of funding on standby. Get it wrong, and you may be waiting years, missing deals, missing returns, and missing opportunities you could have had. But now that you know how whole life works as a private line of credit, you'll need to watch this video to properly add it to your portfolio.